Welcome to the Healthy and Wealthy Retirement, where your certified retirement counselor Mark Struthers takes a holistic approach to retirement, going beyond finances and embracing holistic well-being. This YouTube channel will address not just the financial part of retirement, but also the social, the physical, and the emotional parts of retirement. Everything you need for healthier, a wealthier, and a happier retirement. Here is your host, Mark Struthers.
Hi, welcome to the Healthy and Wealthy Retirement. My name is Mark Struthers. I'm your host. Today we are talking about insurance. And specifically, we're going to talk about permanent insurance here and more specifically, index universal life. Most of these products, or I'd say almost all, once in a while I do run across one where I'm not sure why it exists, are not bad, but often at least when the clients come to us, they appear to be sold just highlighting the pros, not showing the trade-off. So as we move forward, when you're doing this decision, if you're speaking to a commissioned insurance rep, ask them, one, how do you get paid? It doesn't mean they're not going to do a good job for you. And also ask them, give me the pros and cons. Give me the alternatives and the trade-offs. And how does this fit into my financial plan? That's not too much to ask. And if they're really financial planners, they should be able to do it. So in this case, we're going to talk about permanent insurance. And with any type of insurance, you should be asking, what are you insuring? It wasn't too long ago, I was in a presentation that there was an example of actually two clients that have come across my desk in the past 9 months, year. One of them was a daughter of a longtime client, just a wonderful family, an adult daughter, or at least early in her 30s. I can't tell how old people are. Once you get to 50 years old, you just can't tell. But we'll call it somewhere in their 30s. We'll say a 30-something. And she had several term policies. Now these weren't. But she was in her 20s with no kids, no spouse. There was no one that was going to suffer because of her debt. And had plenty of money to, say, bury her, to settle up her affairs. If there was a need for insurance, it was very small. And recently she had a baby and got engaged, and her need for insurance was greater. So also always ask, what am I insuring? And when you look at these projects or these products, ask yourself, is my primary goal insurance? Again, what am I insuring? And then also, if so, the product should be structured that way. If your primary goal is investing, you need to make sure you're looking at alternatives. In our example today, we're going to cover that a little bit. Going in with that mindset, I think, is critical. Too often, people have a primary goal of insurance, and yet they're doing things. Their products they are purchasing don't have enough insurance, and they're really expensive. Quite often, it might be because they have an investment type tilt, or maybe they are paying more for the permanent insurance. Permanent insurance is always going to be more expensive than temporary term insurance. So keep those in mind. To start off with, we're going to go through the pros of permanent insurance, just in general. So there are a lot of pluses. There are no contribution limits like you have with 4Ks or IRAs, no income limits like you have with, say, IRAs. You do have tax-deferred growth. You can get tax-free withdrawals up to your basis. And this one is actually pretty high on the list for some folks, like physicians, creditor protection. So when you're thinking about something that you want to make sure that creditors can't get to, how much you sacrifice or pay for that, that's a separate question. What I find a lot is that when things are sold, it's not that what they're highlighting isn't important. It's just the idea that you pay any price for that often is not for the benefit of you, the client. A death benefit is income tax free. That's a huge one. So we're going to flash up those bullet points. I know for those of you in the podcast, you can't see them, but hopefully you were able to soak those in as I read them. We're going to flash up an example of a real life illustration. So this one is an index universal life. The amount is $100,000 specified amount, $5,000 premium over 20 years equals $100,000. And obviously, if you pass early, your rate of return is high, be like any insurance, because you've paid in so little. But again, there could be alternatives that would be a better fit. Where folks are kind of lured in is the selling point on these is You participate in the upside of the market, say the S&P 500, a very common one. It is kind of the market, 500 larger U.S. companies. It's not all the companies. It's not smaller, mid-cap, emerging markets, international, real estate. But it's the most common. And up to a point, so up to 7%. So it's usually point to point, whenever you purchase it for one calendar year. And you have a 0% floor. So when you first hear the sales pitch, it sounds, well, why not? It's kind of like, I have the upside of the market with no downside. And those of you that are a little cynical might be saying, what's the catch? Well, the catch is that you're never going to get the index. There is no free lunch. And because the stock market doesn't return over 7% every year, you're not getting that. You also have to subtract out the cost of insurance, the commissions, the surrender charges. So you will never get the index. The projected return on this from the insurance company, and the one we're showing up doesn't have surrender charges. Yours could look very different. This is one that is sold to fee-only advisors. The projected return on this illustration, I believe, is 4.76%. And some of you might be saying, well, is that real, Mark? Is that possible? And the answer is probably yes. And it doesn't take long in today's AI world to Google something and get to how many years has the S&P 500 returned that. It was roughly almost 70%. So you can think 70 times 7, or 68% times 7. So that kind of projection is a pretty good starting point. You're not guaranteed that. So could you have an abnormal long, whether you're looking at 20, this illustration goes out 40, or no, it goes out 60 years. Absolutely. You could have an abnormal time where you're getting 7%, 80% of the time. But then you really do got to think to yourself, we've all seen the markets. What are the odds of you getting that kind of return more than the 50 what happened over the last 50 years? Probably not huge, but it's possible. But the main thing you need to be aware is that you don't always get the index. You also don't get the dividends. So you're not actually invested in the S&P 500. There's been times where the S&P dividend has been 2%. I think it's 1.16%. Don't quote me on that. So you don't get that. So when you think of total return, if the insurance company is invested in this S&P 500 over the long term, those of you who study this stuff, like me, you know that total return basis, you can easily average well over 7%. You certainly can get up into and just by the very fact that they're doing this, 7%, if you tack on another 1% for the dividend, that's pretty good. Even when you're done paying, and we'll put up that graphic as well, you still don't get the full call 4.76%. Again, that amount's not guaranteed because of policy fees. So even when you're in if you're done paying after 20 years, if you're in year 40 or 60, you still don't get that full amount. The other thing to notice about this illustration is you can see off to the far right, the death benefit as it grows. If your primary goal is insurance, this one's awful expensive for not a lot of death benefit. Even if you assume the 4.76%, again, could it be higher? It could, but probably not a lot. And you could have your advisor kind of model in instead of kind of 70% of the 7%. What if it was 80? 90. Of course, again, you're starting to roll the dice the further you get up there. But if you're someone whose primary goal is insurance, having 100 to 200K in insurance, especially if when you're younger, you're still working, your kids are younger, maybe college isn't paid for, that might not be enough. That's another thing that I've seen a lot. Part of our business used to be employee financial well-being, and I used to see a lot of insurance policies come through the desk, and that was one thing which I say was a little disheartening. I had younger couples in their 30s with young kids who needed insurance. They could not afford, they couldn't even take advantage of the company match. They had a whole life policy, and I won't go into how it was sold to them, but maybe some level of permanent insurance they needed, but honestly, they couldn't afford it. What they really needed was term insurance, which was a lot cheaper, and they could get a lot more death benefit, which at least for probably the next 5 to 10 years is what they needed. So that's one thing to keep in mind. Most often when these are sold, and this is pretty universal, unintended, is these are sold as an investment. If your primary goal is an investment and it's being sold as an investment, you need to know what's the alternative investment. So the most obvious one with this one is buy term and invest in the S&P 500. So when you think about if I buy term and invest the difference, some of you might be saying, well, but then my term ends after 20 or 30 years. And that might be a reason to do it. If you're someone who says, I want to have life insurance for my heirs, I want to make sure that there's something there when I die. Again, there's nothing wrong with that. But just be aware of the trade-offs, because if you take our example further and say you don't go out just 20 years, you go out we'll go to the end of the illustration, and then when you're 60, when they're 100, your death benefit, it grows to $1 million. Not guaranteed. Could that be a little higher? It could. It's probably not going to be a lot. Could it be a little bit lower? It could. It'll go again. When you think in terms of the S&P 500, unless the U.S. really goes downhill over the next 60 years, it's really unusual. It's going to be a whole lot lower. But if you say that million, you look at that million, you say, well, that's a lot. Well, it's a lot it's a lot now. But $1 million in 60 years isn't going to be the same as $1 million now. Just like $1 million 60 years ago was a lot more money. That's why you had Austin Powers talk about $1 million, and they laughed. Oh, it's because inflation erodes that purchasing. In our example, if you buy term and invest the difference, you're going to be awful close, most likely, to your death benefit, and certainly a lot higher than your cash value. I think the cash value at year 20 was $160,000. Again, the question is, how much do you want to pay for that guarantee? And again, you might like the combination of a product. You do have the insurance that's going to pay early on. Well, if you go beyond year 20, and if we continue to grow that at 7%, not even counting dividends going forward, but forget the dividends even, but that really adds up over these long time horizons. But you certainly are going to get around $3 million. And that's what we're going to talk a little bit about here. I made reference to the fact that there has been times where I've seen things like this where it just didn't make sense. And when that happens, I often see caps, whether it's the floor is zero. So you can't lose anything in essence. But your max upside is a much lower cap. I saw one, it's been a couple years, where it was the same rate as the 10-year treasury. So it had a surrender charge. The one you're looking at now does not. But the most you could get is the cap on the S&P was the 10-year treasury at the time. Well, if that's your max amount and you're not guaranteed it, you're not going to get that every year, as we just discussed. Why not just buy the 10-year treasury? If your primary goal is investment, that's what you really need to look at. So if we were to buy term and invest the difference, so buying $100,000 worth of term for a healthy 40-year-old is not much. I mean, I think I saw one come across my desk where it was, I want to say it was like $10 or $15 a month, $100 to $200. So a year. So if you invest that in S&P 500 and you get what they're assuming, this is 7%, and the fact that the insurance company has it tells you that they even believe that's a valid number. And it doesn't take long to realize that, yes, you can get that. Well, after 20 years, you're going to have over $200,000 in the value of your S&P 500. And you still have the death benefit if you were to pass. The difference is that S&P 500, as you're buying into it, is going to go up and down. Where if you have this insurance policy, it's not priced every second of every day. So you're not going to see it. So that is comfort. And there's nothing wrong with saying, I like comfort. I have seen folks where something like this might be a good fit for them because they do not have the stomach for any sort of market volatility. They can't ignore it. They don't want to take time to understand it. Or they understand it. They just don't like it. Which if you're one of those people, that's fine. But be aware what you're giving up. Be aware that since we're in retirement longer, our longer time horizons, we need risky assets to keep pace with inflation. We need risky assets to to grow our assets to get to a spot to where we can retire and live in retirement for 30 years. But we also need assets in retirement to help compensate for inflation. So as with anything, if you like the comfort of having the 0% floor, that's great. But still take time to realize what's the trade-off, what's the alternative, and what are you giving up? There's risks in all your decisions. The other thing I'm gonna close on here is it's not just looking at the alternatives as far as, like, say, buy term and invest the difference. It's also looking at how it fits in your financial plan. When you think about 30 years of producing income in retirement, something I specialize in, you need to factor in, are you going to need to access this? Will you need to take out some of the basis? What does that look like? The integrating these into a financial plan, whether you're going by kind of the 4% rule or you're doing a probability of success with Monte Carlo simulations or whatever it is, you need to factor in, do you need to access this? Is it going to be taxable if you access it early? What do loans look like if that's what happens? What role does this play? $1,000 invested in something like this over 60 years, you need to make sure that it fits into your income plan in retirement. How does it work with Social Security, your pension, withdrawing from other assets, RMDs, and so on? So, all right, there we have it. So financial planning and investing is all about making informed decisions. If you take some of these tips to analyze whether you're going to purchase an indexed universal life policy or you're going to keep your policy. Again, even if you see this and says, I want to get rid of it, just be careful. That's an episode for another day. You want to make sure you make an informed decision if you're going to keep something like this or get rid of it, because there might be some better alternatives. Thank you for joining us, because if you do all these things, you're going to have a healthier, a wealthier, and a happier retirement. Don't forget to hit subscribe. Do it. Takes a second. Hit subscribe, like, share. Bye-bye.